Good afternoon, everyone. Welcome to our webinar on Budget 2023, major changes from indirect tax and allied laws perspective. So, yesterday's budget happened to be the last budget of the current government before country goes into union elections in 2024. As usual, there are many changes in customs duty rates, which we'll briefly discuss. Plus, there is one significant amendment which the government has proposed to make, which, in our view, will make whole customs regime much more complicated and litigated. So, we'll be discussing that change. Apart from that, post introduction of GST, constitutionally, all GST related changes have to be decided by GST Council only. So, from that perspective, in the budget, only the changes which have to be made in GST law, those are being proposed. But still, in this budget also, there are certain changes which we'll be discussing, which were never discussed in GST Council meeting, which government has proposed to do it now. So with this, we start our webinar. I am joined by my colleague, Rishabh, who will take us through the customs related changes.
Yeah. So thank you, Puneet. Good afternoon, everyone. So in this entire webinar, we will be discussing the aim, the changes made, the misses of the budget, and then we will have a live Q&A round. So firstly, discussing the aim of indirect tax proposals. So this year, the indirect tax proposals of the budget aimed at promoting exports, giving a boost to domestic manufacturing, and enhancing domestic value addition. So for this purpose, BCD rates on various goods have been reduced, or the BCD rates have been exempted. Now, there are certain other aims as well, which includes encouraging green energy or encouraging green mobility. So for this purpose, the government has exempted custom duty on import of capital goods or machinery which are used for manufacture of batteries in EVs. So moving towards the changes. So firstly, we shall be discussing the changes in the customs laws, the rate changes specifically. So as regards the rate changes, the BCD slabs have been reduced from 21 to 30. So this change shall ensure that we are in a simplified tax structure with fewer rates. As regards the next change, so a brief introduction is required. So chapter 98 of the first schedule of Custom Tariff Act deals with project imports. So in this regard, heading 9801, which deals with solar power plant. So heading 9801 has been amended to exclude solar power plant or solar power projects from project imports. So there have been, as Puneet discussed, there have been significant custom duty rate changes in this budget, but primarily the major changes would include the coal changes in BCD rates of coal, peat, lignite, wherein the BCD rates have increased. Changes in BCD rate of vehicles in CBU and SKD form, wherein the BCD rate has been increased, and simultaneously the SWS has been exempted. The next is changes in BCD rates of camera lens and parts used in manufacture of camera modules. Herein the BCD rates have been reduced. And then denatured ethyl alcohol for industrial use. Once again, the BCD rates have been reduced. So apart from that, there are many new tariff items which have been inserted effective May 1, 2023. However, it should be noted that these shall not have any impact on the BCD rates. So moving forward to the customs legislative changes. So in this regard, a brief background is required. So section 25 subsection 4A of the Customs Act 1962, which was introduced by Finance Act 2021, provided a sunset clause for conditional notifications for 2 years. So these notifications were set to expire on 31st March 2023. However, this budget has proposed that this section 25 subsection 4A shall not apply to exemptions which have been granted through foreign trade agreements, the schemes under FTP like the Advance Authorization, EPCG scheme, exemptions on reimports or temporary imports. And lastly, the exemption on duties other than BCD like the IGST.
So this is the most important change which I was talking about, and in my view, this change will make life of importers difficult as to determining correct rate of customs duty. Similarly, these can undergo a lot of litigation with custom authorities. And why I'm saying so is that firstly, this provision only applies to conditional exemptions. So at first stage, an importer should segregate which type of exemption he's availing. If it's a non-conditional or general exemption, then that's there is no sunset date. But if it's a conditional exemption, then there are multiple possibilities which are there. If those exemptions have been issued prior to March 2021, then ordinarily all such exemptions will expire in March 2023. So, as part of yesterday's custom duty rate changes, for many exemptions, they have specified a period of March 24, March 25, and in fact for March 28 also. So, the importer should presently see for conditional exemptions which have been issued prior to March 21 or otherwise, will they actually expire in March 23 or not? Or those have been extended. So this will be a regular process which importers should undertake to track wherever they are availing conditional exemptions. Those conditional exemptions can be like subject to end use, subject to following of IGCR rules, etc. So the general tendency which used to happen earlier, oh, if an exemption is there, I'm entitled till it's withdrawn. It's not so. So we need to see when it is issued, whether it has a sunset date on its own, or otherwise subsection 4A or section 25 will apply or not. So in our view, this is a very important change, which almost all of you, because in today's business, every company has significant import volumes. So they need to track validity of their exemptions.
So the next important change relates to the GRI, which are provided in the customs laws. So in this regard, the change is, or it's a sort of a clarification only, that if an article which falls under 4 dash and it is preceded by a single dash or a double dash, then such article must merit, such article shall be classified as in sub classification of an article having 3 dash. So in this regard, it is pertinent to note that there are many tariff items which are being currently classified based on this clarification only. So with this, we come towards the end of custom changes. Now Simran will take us through the GST changes. So over to you, Simran.
Thank you, Rishabh. Good afternoon, everyone. Now we'll be moving forward to GST related changes. Starting with taxability, the transactions like merchant trading, sale of warehouse goods, and high sea sales, these were brought in Schedule 3, that is, transactions or activities which are neither treated as supply of goods nor treated as supply of services from February, February 2019. So many taxpayers were receiving show cause notices from the department stating that they are liable to pay GST for the period before February 2019. So, to cater this situation and to clarify on the same, amendment has been proposed to state that these Schedule 3 entries will be effective from July 1, 2017, and in case any taxpayer has paid GST for the past period on these transactions, in those cases, no refund will be allowed. Also, activity of sale of warehouse goods will be deemed as exempt supply for the purposes of ITC reversal, and the value will be prescribed through the rules.
So, a couple of things relating to this amendment. Again, this is one of the amendment which was never discussed in the past, because there are a number of activities which are specified in schedule, including high C sales also. So, even for high C sale, even currently no ITC reversal is needed. So, we fail to understand as to why the government wants taxpayers to reverse ITC relating to sale of warehouse goods. Secondly, one another surprising thing is, even if reversal has to be done, why there is a need of prescription of value? Because generally the rule is that if there is an exempt supply, whatever is the value of supply, so which is a sale consideration, that should be subject to that should be the turnover for ITC reversal. The only exception has been created for shares or securities, etc., where 1% value is prescribed. So very, very surprising change. And again, in our view, this lacks logic, and taxpayers need to forego their credits because of this.
Yeah. Moving forward, next big change is regarding input tax credit. It has been proposed to restrict ITC on goods and services which are used or intended to be used for CSR purposes. So, as of now, there is no specific restriction on these expenses. The next question which arises is that whether a taxpayer will be eligible to avail ITC on expenditure which is incurred beyond 2% mandatory limit. So for expenditure on goods which is incurred beyond 2% mandatory limit, taxpayers will be hit by the specific restriction under Section 17(5)(h), which restricts ITC on goods which are disposed of by way of gift. Further, for services, for the expenditure on services which is incurred beyond 2% mandatory limit, there is no such restriction. Importantly, since this is a ITC related change, so it's substantive in nature, it will forego the right of taxpayer to avail ITC on these expenses. So it will be treated as prospective in nature. Therefore, till the time this amendment comes into effect, a taxpayer is advised to avail ITC on these expenses so that they can reserve their right.
So, just to add a couple of things. One, many of our clients, they used to say that income tax law has a specific bar that you cannot claim reduction of CSR. So therefore, we should not be allowed ITC under GST. And we have been discussing for almost last 5.5 years that no, even in income tax law, this change was brought in 2011-12. Prior to that, in an income tax law only, there is settled jurisprudence that CSR expenses are eligible for deduction under Section 37. So this amendment makes it very clear that if there are taxpayers who have claimed ITC for the past, those credits were valid. In any case, because all states also need to align themselves for making these amendments in SGST acts, so it will still be a matter of few months before this change happens. So we feel that for the current financial year 2022-23, this credit is clearly available. And for some or significant part of financial year 23-24 also, it will be available. Secondly, because the restriction is for CSR obligation under the Companies Act, which is mandatory 2% only. So beyond 2%, ITC should be available, except for the bar that goods distributed by way of gifts. So if beyond 2% expenses have been incurred on goods, then ITC will not be available. But if it's incurred on services, then ITC can be claimed. So to that extent, in our view, even though this curtails a right for the past, but it clarifies the position for future. And we have many clients who spend much, much beyond this 2% limit. So they still have a room to claim some part as ITC.
Moving forward, next is a refund related change. It has been proposed to put an enabling provision in section 56, which deals with interest on delayed refunds, so that it can provide the manner of computation of interest. So this has been mainly done to cater the situation like in the cases where department fails to give refund to the taxpayer in the case of technical glitch, or in case any information is delayed or not provided by a taxpayer. So this provision which will cater those situations, and most probably they'll prescribe the starting date of refund as the date when full or complete refund application is filed by the taxpayer.
And this is totally in line with the custom regulations also, which specifically provide that for the purpose of computation of interest on delayed refund, the starting date will be the date of filing of complete refund application and not the initial application.
Yeah. Moving forward to certain changes which are proposed in the definitions of in IGST Act. First is the definition of non-taxable online recipient. It has been widened to remove the condition of receipt of OIDIA services for purposes which are other than business or profession. Secondly, there is an amendment proposed in the definition of OIDIA services, wherein it has been proposed to remove the condition of rendition of services being essentially automated and involving minimal human intervention. Now, since this phrase, that is involving minimal human intervention, is very subjective in nature, so there are multiple ARs which have dealt with this phrase, and there are contradictory rulings. So it has been since now it has been completely omitted. So the department is very well expected to widen the scope of OIDIA services and demand tax on these. Next thing is regarding place of supply. Proviso to section 12.8, which deals with place of supply wherein transportation of goods is outside India and recipient and supplier is located in India, is proposed to be omitted. This talking about the history of this provision, it was introduced in February 2019 with an intent to make transportation of goods outside India as export of services. However, this intent was not fulfilled as the recipient in these cases was a recipient and supplier in these cases were located in India. Further, a circular was also issued to clarify that IGST charged by the supplier will be available as ITC to the recipient. However, now it has been proposed to completely omit this proviso to reduce all these confusions. Next are returns related changes. An upper limit of 3 years from the due date has been provided in the Act to state that a taxpayer will not be allowed to furnish following returns, that is return under section 37, 39, 44, 52, if he fails to furnish these beyond till 3 years from their respective due dates. Importantly, this change is very unjust, as if a taxpayer is willing to pay tax with interest or penalty after due dates or after 3 years, he will be barred from furnishing those returns. And second important thing is ITC 04, that deals with job work return, is not covered in this restriction. Next most important change is with respect to registration. There was an anomaly in the industry for the cases where a person is specifically exempted to avail registration, like in the cases where a person is exclusively engaged in making exempt supplies or making RCM supplies. In those cases, if the person receives any supply on which RCM is payable, so will he be mandatorily required to obtain registration or not? So till now there was no clarity on this issue and there was a confusion. So to clarify this issue, a retrospective amendment has been proposed to state that a person will not be required to mandatorily register in these cases if he has been specifically exempted to register. Next proposals are with respect to penalties, prosecution and compounding. First is with respect to a fresh penalty on ECO when goods are supplied through them by unregistered person or composition taxpayers, or in case the ECO furnishes incorrect return. Importantly, in these cases, an ECO is being held liable for the default of persons who supply goods through them. So, this penalty is unjust. Moving forward, certain offences have been decriminalized under GST. These include obstructing or preventing officer from discharging his duty, or deliberately tampering with material evidence, or in case a person fails to provide information. Also, the prosecution threshold has been increased from 1 crores to 2 crores, except in the cases where fake invoicing is there. Also, the amount of compounding of offences have been reduced as shown on the screen. Moving to other change, a specific provision has been introduced in the GST Act, which states that the common portal can share information to certain notified systems, and this will be subject to receipt of consent from the supplier and recipient. So these information include particulars which are furnished during obtaining registration, or the details which are furnished in returns, or while generating e-invoice, or while generating e-bill.
So this is an important change because for quite some time, government has been talking about exchange of information between different arms. So this seems to be the enabling provision in which GST authorities can share data with income tax authorities or RBI or Companies Act, etc. But yes, one important thing to highlight is that the government has put sufficient safeguards from a data privacy perspective. So this cannot be shared unless taxpayers' consent is obtained.
This was all from the proposals and changes perspective. Now Puneet will be covering the misses of this budget.
So thank you, Simran, for covering GST related changes. Now we discussed till now what budget has done. Now we'll discuss what was expected from the budget and not done. So we conducted a poll. Many of you might be aware that the government has been talking about replacing current SEZ law with DESH Bill, and even a draft came out last year, etc. And there were some press statements that in the current budget, the government will introduce the final DESH Bill. So we ran a poll and asked the participants, do you expect the union government to present DESH Bill in union budget? So 63% people said yes, but we find DESH Bill conspicuously absent. Even there was no announcement that whether it will be coming in the tenure of this government or not. So notable misses, in our view, are one, DESH Bill, which we discussed. On one hand, government says that it wants to promote exports, etc., and DESH Bill was expected to provide an impetus for that, but there was no announcement for that. So we don't know when it will come. Another important miss is any announcement on the new foreign trade policy. So many of you might be aware that the earlier foreign trade policy was from 2015 to 2020. And since March 2020, government has been regularly extending it. And again, government made repeated press statements that new foreign trade policy will provide a lot of incentives, benefits to exporters, etc. They want to take India's exports to next level. Again, there is no announcement on that. So it will not be surprising that the tenure of 2015-20 policy is extended beyond March 23 as well. Third, GST Appellate Tribunal, which is very much need of the hour because there are many cases which are getting rejected at Commissioner Appeals level for which no appellate remedy is there. So there was no announcement on that. So we do not know the fate of GST Appellate Tribunal as well. Last and most important was that similar to direct tax or excise or service tax amnesty schemes, there were a lot of representations from industry to bring an amnesty scheme from a customs perspective, because presently there are many disputes from show cause notice to appeal stage on custom front, and many importers, exporters, they are interested to settle them. And in fact, prior to the budget, it was in news also that such a scheme will come, but this was also missing in the budget. We ran another poll in which we asked the participants that if they intend to avail benefit under Customs Amnesty Scheme if it comes through, and very encouraging response that 90% were interested, but unfortunate, we need to still wait for this. So with this, we come to end of today's session. Thank you for joining in large number, and we'll meet you soon. Thank you.